Every trader watches the dollar. Every economist watches the CPI. But there's one currency pair quietly forecasting both. Weeks, sometimes months, before the data hits the headlines. A single exchange rate that has become the world's unofficial inflation barometer. It doesn't sit on CNBC tickers. It's not a G7 headline. But when it moves, global prices follow. This is the story of the currency pair that predicts global inflation. To understand why, we need to start with what inflation really is. At its core, inflation isn't just about prices rising. It's about the balance between money and things. Too much money chasing too few goods. And in a global economy, where everything from oil to microchips to wheat crosses borders, currency movements are the hidden language of that imbalance. Now imagine you could find the one pair that best captures this global dynamic. The pair that tells you when money is getting stronger and when goods are getting more expensive. That pair exists. And it's not euro to US dollar or US dollar to Japanese yen. It's the one pair that bridges the East and the West. That links the factory of the world to the consumer of the world. USD/CNH. The US dollar versus the Chinese yuan. Because this isn't just a currency pair. It's the thermometer of global cost pressure. When the yuan weakens, China's exports become cheaper. Goods flood Western markets at lower prices. Inflation cools. But when the yuan strengthens, factories raise prices, commodities tighten, and inflation rises everywhere from Berlin to Boston. And here's the eerie part. This signal often shows up months before official inflation data does. Why? Because global trade reacts instantly to currency moves, while consumer prices take time to ripple through supply chains. Think back to 2021. The yuan began strengthening sharply against the dollar in the spring. That should have been a warning sign. China's export costs were rising, energy prices were tightening, and shipping rates were already doubling. 3 months later, Western inflation took off. Then look at mid-2022. The yuan began to weaken rapidly as China's economy slowed and the PBOC cut rates. That signaled deflationary pressure. And sure enough, by early 2023, global inflation started cooling from its peaks. It's uncanny how closely the USD/CNH line mirrors global CPI curves, lagged by a few months. When the yuan falls, inflation falls. When it rises, inflation rises. It's not perfect, but in macro terms, it's as close to a leading indicator as you'll ever get. But the story goes deeper. Because USD/CNH doesn't just reflect price levels. It reflects policy divergence. The Federal Reserve and the People's Bank of China operate on opposite cycles. When the Fed tightens, the dollar rises, and imported goods become cheaper for Americans, cooling inflation. When the Fed pauses or cuts, the yuan often rallies, raising global input costs. So the USD/CNH pair effectively tracks the pulse of global liquidity, a tug-of-war between tightening in the West and easing in the East. There's another layer. China's currency is managed, not free-floating. So when the PBOC allows the yuan to appreciate or depreciate, it's not random, it's strategic. A weaker yuan boosts exports and offsets global slowdowns. A stronger yuan signals confidence, or sometimes a willingness to absorb inflation to stabilize imports. So, in a way, USD/CNH doesn't just predict inflation. It reflects how China chooses to engineer it. Global investors are catching on. Macro hedge funds now use USD/CNH as a lead input for their inflation and commodity models. Commodity traders track it as an early warning for cost-push inflation, and sovereign wealth funds monitor it for clues on capital flows. Here's a striking example. In late 2023, the yuan began strengthening quietly while oil prices were still high. Analysts dismissed it as technical. But 2 months later, China's reopening drove a surge in demand for raw materials, pushing global producer prices higher. USD/CNH had warned them first. Even central banks are paying attention. The ECB and BOJ both reference yuan movements in their inflation outlooks because they know the world's inflation cycle no longer starts in the US or Europe. It starts in Shenzhen, in Guangzhou, and Shanghai. Factories that price their goods in yuan before the rest of the world converts them to dollars. So, if you want to forecast the next inflation wave, don't just watch CPI. Watch USD/CNH. When it breaks key levels, it's not a currency story anymore. It's a macro story, a signal that global prices, trade balances, and monetary policy are about to shift. The data proves it. Across the last 2 decades, a falling USD/CNH has preceded rising global CPI by roughly 3 to 5 months on average. And when USD/CNH spikes upward, global inflation cools almost every time. That's why the world's smartest macro desks are now using this pair, not just as a trade, but as a forecasting tool. Because it's not only the world's most geopolitically sensitive currency, it's also the clearest lens into global price pressure. So the next time you hear talk of inflation mysteries, remember, the answer might already be moving quietly in the Forex market. It's not the dollar alone. It's the relationship between the dollar and the yuan, the invisible line connecting factory floors in China to grocery shelves in Europe, the line that tells us what's coming long before the economists do, the currency pair that predicts global inflation, USD/CNH. If you found this insight eye-opening, hit that like button, share this with your network. Comment your thoughts on how AI, currency policy, and inflation intertwine. And subscribe for more world-shaping stories that connect the dots between money, markets, and power. Because in global finance, the real signals are never on the surface.